cut out the middleman and become your own banker. Welcome, my name is McCluskey. I'm a financial strategist, and I do not like when I don't have control over my money, whether it's a company or a bank that has control. And I especially wouldn't like if they were loaning that money out from me at a very low rate and taking it to earn a much higher rate that I could very easily do myself. We give our money to banks. It's in a liquid position. They then take that money, loan it out, or invest it to earn a higher rate of return. Today, we are going to be talking about how you can take your liquid money instead of just leaving it in a bank that's earning nothing and getting that, number one, growing far more than it is now. Number two, taking that money and getting it growing in a tax-deferred status instead of just paying taxes as earned. Number three, when we want to access that money, being able to actually do it tax-free, even though it's tax-deferred or growing tax-deferred. And number four, completely forget about that tax deferral status when we die and having that money transfer and even blossom completely tax-free. Let's get into it. Number one, getting the money growing far more than it is now, but also still keeping it in a liquid position. The vehicle that we're actually going to use to do this, believe it or not, and the wealthy have been doing this forever, is life insurance. Here's why. So many of you might be familiar with a high yield savings. What happens is we give money to a bank. They're able to credit us a certain rate of return. Let's say it's 4%. Why are they able to credit us that? Well, we put money in the bank. They're taking that money, loaning it out, investing it, and they're earning more than the rate they're crediting us. Insurance companies are actually doing the exact same thing. They have a general account portfolio rate, and if we have cash value inside of an insurance policy based on that general account portfolio rate and the money they're earning, they're going to be able to credit us just a little bit below that, very similarly to how a high yield savings functions. Okay, so now we are earning more than your regular savings account, but why not just do this with a high yield savings if they're about the same? Here's the idea, and what we'll hit on in our next points is the tax treatment of the cash value inside of a life insurance policy is much different than a high yield savings. When we put money in a high yield savings and we are getting interest, we are paying taxes on that interest. Well, when people realized not just how different, but how favorable the tax treatment was on the cash value, what they started doing is finding out, how can I pay the most possible premium, the highest price that they'll allow me to pay for the least amount of death benefit? And yes, there's the cost of insurance fees that I'll take at the very bottom of the money that I'm putting in, but all of the rest of the money is going towards my cash value and get the favorable tax treatment on that money that's growing inside of a life insurance policy. So this leads us into our point number two, which is getting that money growing in a tax deferral status. Where can we do this? Life insurance. According to Internal Revenue Code 7702, cash value that is growing inside of a life insurance contract is growing tax deferred. Okay, well that's great, but kind of like a 401k or an IRA, I imagine I'm going to have to recognize that deferral status later when I take it out, right? Wrong, if you're smart. Number three, even though that money is growing tax deferred, we don't have RMDs or required minimum distributions that we have to take out. We're never actually going to withdraw. Here's the idea. Instead of withdrawing that money and recognizing the tax deferral status, what we're going to be doing is taking policy loans. Because we never recognize the gain of that money and we're just doing through policy loans, according to the Internal Revenue Code section 72E, when we access that money through a policy loan, the tax implications are, you guessed it, none. So even though it's tax deferred, no taxes. This leads us to number four. Well, that's great that we're able to access our money with no taxes, but certainly at some point the deferral status has to be realized. Is it when we die? No, it actually doesn't have to be realized because this is life insurance. Under the Internal Revenue Code section 101A, life insurance transfers what? Completely income tax free. So even though we may have had a loan balance, let's say the loan balance was $500,000 and we had a death benefit of $2 million. Well, our death benefit just pays off the loan balance first and then the rest of it transfers tax-free. So if you had a loan balance of $500,000, the $2 million death benefit pays that off and then there's $1.5 million left to transfer to our heirs completely tax-free. So imagine it all together. You either have option A where you're keeping your liquid money in a bank where they're going out earning a higher rate of return by loaning it or investing it, and then crediting you back a much lower percentage. Or you could cut them out and you have option B. Option B, you're earning a much higher rate of return, but you're also doing that in a tax-deferred environment. But even though that's tax-deferred, you're able to access that money through policy loans, which are completed as what? Completely income tax-free. And when you die, that money is going to pay off the loan and then transfer completely tax-free. And it's actually going to blossom because the death benefit always has to stay a little bit ahead of your cash value. As always, these videos are made to show you that these strategies exist and can be practiced well, but they need to be treated with extreme care. Over 95% of these policies are done completely wrong and will actually end up blowing up in the client's face. If you'd like to learn more, please take your time, do your research, and if you'd like to do exactly that, be sure to subscribe. I release videos that go into much greater detail than this. I upload videos 5 times a week. I look forward to seeing you in a future video. Bye-bye.